Hey everyone, welcome back to Corporate Decoder. Today, we are diving into a filing from Molecular Templates, Inc., and it seems like they are trying to keep the lights on while they explore their options, which is probably a fancier way of saying we are running out of money. This report is about events that happened on February 20, 2025. Essentially, Molecular Templates, a company in the tough world of biotechnology, needed money and made some deals to get it. Let's break down what these deals mean. First off, Molecular Templates, Inc. is the name of the company. Think of them as scientists trying to create new medicines. The first big thing is that Molecular Templates got what is called a bridge loan. This is basically like taking out a short-term loan to keep things running while you figure out a longer-term solution. They got this loan on February 20, 2025. This loan is under an agreement with K2 Health Ventures LLC, who are acting as the lender's agent, and Incura Trust Company, LLC, who acts as collateral trustee. Basically, there are multiple lenders involved, with a couple of entities managing all the details. The company got an initial loan of $560,000 right away. They can ask for more loans later if the lenders agree. These additional potential loans are called discretionary incremental bridge loans. The money from these loans is supposed to be used for specific expenses that have already been approved or that get approved by the lenders in the future. This initial loan has to be paid back by April 21, 2025. That's the maturity date. If Molecular Templates can't pay it back by then, or if something else goes wrong, they could be in big trouble. The interest rate on this loan is a fixed 13.5% per year. This interest will be added to the amount they already owe each month. To make sure they get their money back, the lenders have a claim on pretty much everything Molecular Templates owns. This is called collateral. This includes their ideas, inventions, and their ownership in other smaller companies, but not everything. There are a few exceptions to what the lenders can claim, but basically, if Molecular Templates doesn't pay up, the lenders can take their stuff. There are also rules Molecular Templates has to follow while they have this loan. They can't take on too much more debt, sell off important parts of the company, or make big changes without the lender's permission. If Molecular Templates messes up, like not paying on time or lying about something, they will be in default and things get even worse. The interest rate goes up and the lenders can demand all the money back right away. Alongside this new loan, Molecular Templates also changed another agreement they had. It's called the Amended CVR Agreement with K2 Health Ventures. This agreement has to do with something called a contingent value right, basically the right to receive something of value if a certain event occurs. This new agreement replaces an older one from June of 2023. The obligations under the amended CVR agreement remain secured by the collateral, meaning it's also protected by the assets the lenders have claims to. This agreement has a repayment deadline of February 1, 2026. Now, here's a warning from the company. They say that buying and selling their stock is very risky right now and it may not reflect the real value. In fact, they don't expect their investors to get their money back. The company also doesn't expect to be able to afford the administrative obligations of being a public company, so they're urging people to be very careful. If you want to dive into the specifics of these agreements, you can find the full legal documents attached as exhibits in this filing. So what's the story here? Molecular Templates is struggling and they've taken out a short-term loan to buy themselves some time. They've also reworked an existing agreement to try and make things work, but the company is warning investors that things are very uncertain. Now let's talk about what this all means. Molecular Templates is clearly facing some serious challenges. The fact that they need a bridge loan and are warning investors about the value of their stock is not a good sign. The high interest rate of 13.5% on the bridge loan shows how risky the lenders see this investment. It makes it harder to improve their financial position since they would need to cover that interest. On the other hand, they are actively working to find a way forward by seeking funding to pay for expenses. They have assets, even though they might not expect to be able to pay investors back, and they're trying to buy more time by amending existing agreements. They're not giving up, even though they are up against it, which could be the best thing for their investors. Overall, Molecular Templates is in a tough spot. There are significant risks, and it's hard to say if they will be able to turn things around. It might just be that they're running out of money, like we said at the beginning. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.